Hello, everyone. It's Andrew Ross from Chat Integrated Media. Welcome to the Great Canadian Aftermarket Trade Show virtual event live session. So this is on a Zoom platform. Maybe you're familiar with that already. We have a Q&A utility. We also have the ability to pose questions through the chat. And my preference for this, because it is a live event, we have this great opportunity to pose questions to our lead panelist, keynote panelist, as it were, for the event, is to raise your hand, and then you can ask the question live with your voice, how you want to phrase it, and maybe even a follow-up if it's appropriate. So without further ado, today's topic for kicking off our event is the financial markets and the aftermarket. Now, while most of us spend our days really working hard on the kind of minutia of getting parts sold, installed, repairs made, and running our businesses, the financial markets and the economy at large is the manifestation of all those cumulative efforts. Today, I'm very pleased to have Karl Berger of Cidel Asset Management to talk about the context of what's going on in the economy, in the financial markets, and in the automotive space. Welcome, Karl.
Hi, Andrew. Thanks for having me.
My pleasure. Now, obviously, we've had an unprecedented swings in the economy, swings in the financial markets over the last year and a bit. What's going on?
Well, that's a broad question to start with. Lots of different ways I could approach that. I think most of the people on the call, many of the people that are listening, would certainly have had their own experience over the course of the last year since March of 2020. Obviously, a fairly significantly uncertain period in the financial markets and the automotive industry and the aftermarkets segment, and there's lots of parallels, obviously, between all three based on the uncertainty of the trajectory of the pandemic, certainly through the first sort of 5 or 6 months of the crisis last year. And then ever since November, I would say, and the arrival on the scene of the vaccines and this hope that the pandemic will actually end in a foreseeable sort of period of time, there's been an awful lot of economic activity. There's been an awful lot of focus on reopening of the economy. And I guess I should actually go just back a little further than that and talk about the underpinnings of that economic recovery, and that being the totally unprecedented monetary and fiscal stimulus and support that we've seen from central banks and governments all over the world. And it's probably not surprising that the actual low in the equity markets on March 23rd of 2020 corresponded the day previous with the announcement of a very, very significant stimulus package in the US. And so since then, we've had a number of similar packages announced all over the world, all over the developed world, I should say. And this unprecedented government and central bank activity has gone a long way to certainly not ensuring an equitable outcome for everybody, but trying to ensure that the economy can continue to function as we come out of the pandemic and reopening occurs. So it's been a completely unprecedented time from a financial standpoint, from an economic standpoint. Everything obviously is tied together in that regard to a degree. But we find ourselves in May of 2021. I think most people would be extremely shocked and surprised at where equity markets are and financial markets are overall, especially if you were to talk in March of 2020 and say, well, will we be where we are now a year from now? Almost 100% of the people would have said not a chance. There's no way that we will be in the position that we seem to be now. And that doesn't for a second say that everybody has been dragged along. There's still been a huge dislocation in the economy that isn't necessarily reflected in financial markets. And maybe that's a good place to probe further. I'm not sure where you'd like to take the conversation.
Sure. Well, one of the indicators that I've noticed, and which is kind of foundational for how well, I guess, the economy does, and by extension, the aftermarket, is the really significant dips and rebounds in employment numbers. So that has come back quite a bit. And sort of knock-on effect to that, or related to that, are some of the things that seem to be a very different approach for, and again, not just in Canada, but for governments and how they view, the stimulus and the growth, and what the right things to do are. There are certainly those out there who are warning against the dangers of inflation. And you and I talked a little bit before that there seems to be a bit of a different approach now, that, without getting too much into the weeds about it, that might be at the root of how the governments are approaching this crisis as opposed to previous crises of an economic nature.
Okay, so let's go back to just before the pandemic, end of 2019, January, February of 2020, and the global economy, and the US in particular, had got itself to a position where unemployment was far, far lower than anybody would have believed possible and sustainable. And so unemployment in the States has typically run around 5 or 5.5% as the lower end from a structural standpoint. There's a certain number of people that are simply not going to be employed at any given time because of their personal circumstances, because of a number of different things. The US breached that 5 or 5.5% bound at the end of 2019 and was down to about 3.5 or 4% unemployment. And so obviously since then, there's been a couple of different things happen. The economy, great swaths of the economy were shut down. The government support that I talked about came in. And what the government support was basically intended to do was to ensure that as many businesses as possible don't go out of business as can possibly be constructed, so that those jobs are there to come back to when the lockdowns and the forced closures that were either necessary or not necessary, depending on your orientation, to fight the pandemic. Governments didn't want those jobs to disappear permanently. A restaurant goes out of business, somebody may come in and take it up and start over, but there's a huge disruption to the employment, to the revenue stream of that building, to the knock-on effects of the economy. So the intention has been, through all of the stimulus, to try to keep employment losses temporary. We're at a point right now where there's still a significant number of people unemployed in the developed world compared to what we were at in January or February of last year. But what's shifted, and it's not just because of the pandemic, we think that there was that shift happening before the pandemic. It looks like governments and central bankers globally are starting to try to target employment and to get as many people as they possibly can be employed without creating significant inflation. And it's a huge, huge shift in terms of the way, if it's actually real and if it's sustainable, it's a huge shift in the way that governments appear to be thinking about monetary and fiscal policy. Most people on the call will understand that Canada ran an almost $400 billion deficit for fiscal 2021. Numbers that are just completely unheard of in my lifetime, in any of our lifetimes. We're going to run another $150 billion deficit this year. And that's partially because economic activity isn't going to pick up to where it was prior to the pandemic, but it's also because there's still significant supports for the economy and significant stimulus that's being built in over the next 5 and 10-year plans to ensure that we get back to a level of economic activity and employment that we were at prior to the pandemic. In order to facilitate that, central bank authorities seem to be willing to tolerate a fair amount of inflation relative to what we've been used to over the last number of years. It's sort of run around 1.5 to 2%, and those are official inflation statistics. They're not what everybody experiences in their day-to-day lives, unfortunately. And we can talk a little bit about that if you really want to get into the weeds of how the CPI is created and tracked. But for the purposes of understanding the financial sphere at this point, inflation isn't at a level that's problematic, and that probably won't ring true for a number of people on the call who may be running into supply issues with semiconductors and things like that. I mean, there's all kinds of inflation in different parts of the economy at this stage. But if the target really has shifted to getting as many people as we possibly can back to work, tolerating slightly higher inflation than we've had in order to do that, of course, we run the risk that inflation becomes endemic or rampant, and that we get more inflation than we really want. That's a massive sort of policy risk of the new approach. But it's fascinating for us as money managers, because if that approach sticks, then it essentially means that the governments and central bankers globally are going to run the economy hot for a long time at full capacity, or maybe even trying to target above it in order to get people back to work. That could have some consequences down the road, but it should be extremely good for risk assets, and it should be extremely good for overall economic activity. Doesn't mean that everybody's going to benefit from it, and that this is, again, where there'll be massive problems from a policy standpoint. But it's a fascinating shift if it's actually real and sustainable.
Right, right. It's certainly, and again, we don't want to turn this into, economics 101, continuing education, and we could certainly go on. But I want to just shift gears a little bit, and in the context of these things, we want to talk obviously about the automotive space and the aftermarket. Uh, I think there's a little housekeeping you need to do just to let people know kind of where Cidel and you are at as far as the automotive space in the aftermarket, and then give us your thoughts on what you see going on in the space and what your observations might be there.
Sure. So maybe I'll just set the stage by saying that Cidel is a money manager. We manage portfolios for individual clients, for institutions, and for high net worth families and family offices. So we cover the whole sort of gamut in terms of management. We've got a number of different approaches that we use depending on whether, for an institution, we want to be a little bit benchmark aware, and we don't want our portfolios and our results to stray too far from what the TSX, for example, does. We don't employ that same sort of methodology in our private client approaches, so we've got a little bit more flexibility. But to answer your question specifically, in terms of the automotive industry at this point, we have almost no direct exposure across any of our mandates. We up until January, I think, or maybe mid-February, we had some exposure to Magna in our core portfolio that we used for institutions. That's a little bit more benchmark aware, and we don't want to have no exposure in that sort of approach, but we actually did sell out of Magna at some point in the last few months, just based on valuations. So we don't have much exposure at this point, and that's primarily, well, there's a number of factors behind that. We obviously view the automotive and the aftermarket sector as fairly cyclical, and I'll make some broad general comments. I don't want these to be construed as a criticism of any individual company or part of the sector or whatever. There's different parameters that Cidel has and that we look at when we manage portfolios, and all of the comments that I'll be making will be within the context of that. But we typically view the automotive sector and the aftermarkets parts sector as being highly cyclical. Right now, we see it as being very fully valued, fairly optimistic in terms of the earnings guidance that we're seeing out of companies individually, and investors are willing to pay very, very high multiples for that earnings guidance. So when you have a cyclical industry, guidance is robust and valuations are robust. You've essentially got a scenario where things have to go really, really well, or things have to go really, really right over the next 6 to 12 months to create a significant amount of value. And I'd say that we're finding opportunities in other sectors where things either aren't as robust from a guidance standpoint or aren't as fully valued. So the opportunity set is a little bit better. That doesn't mean for a second that Magna can't continue to go up, or that any individual company in the automotive sector can't continue to do very, very well. And I mean, if you look at first quarter earnings results from almost anybody. The results are generally very, very strong, especially when compared to the first quarter of last year. Forward guidance is typically pretty good. Seeing lots of dividend increases, some stock buybacks, which generally speaks to the fact that free cash flow generation is high. So we don't have a whole lot of exposure to the sector at this point. Not to say that we never would, but at this stage, it doesn't grab us from a valuation standpoint as much as anything else.
Sure, sure. But from looking at it and sort of the same kind of parameters that you brought up as making it not a lot of kind of delta between what you could get it for and what you might be able to earn out of it. It does speak to a certain stability that for those of us who work in the automotive space and in the aftermarket should take some encouragement from, no?
Oh, I think so. I mean, you'd know that from how robust your order backlogs are and how things are evolving in your business. I mean, I think there's a lot of reason to be optimistic over the next 6 to 12 months in a lot of different sectors of the economy as we come out of this pandemic. I mean, consumers, Canadian and US in particular, but even in Europe and other parts of the developed world, consumer balance sheets are in great shape right now. I mean, anybody that has been employed over the last 12 months hasn't been spending anywhere near as much money as they would have otherwise. Maybe that's brought some spending in the automotive sector forward a little bit, and you're getting some of what might have been spent over the next couple of years having been spent while people were kind of locked down and not going anywhere. But in general, consumer balance sheets are in great shape, which means that they should have money to spend for the next little while. Our sense is that the economy isn't going to open up rapidly. It's not like everybody will be traveling again in 2021. So there's no reason to think that the dynamics that existed through the latter part of 2020 might not still exist through 2021 for most consumers. So yeah, I think most of the folks in your sector, and especially on the retail side of it, are probably feeling pretty good. I would say from a portfolio construction standpoint, if you or your this audience has investments, they probably shouldn't be invested in automotive companies and in the automotive space or sector simply because your employment and your employment income depends on the health and the vitality of the automotive sector. Having investments there sort of compounds that, and people often feel like they know that sector, they're comfortable with it. So of course you're going to go and invest in what you're seeing, and that's certainly fine with a portion of your portfolios. But from a portfolio construction standpoint, you probably don't want to be over concentrating your exposure in a single sector, no matter how good it looks or feels.
Right, right. Well, that's just good general advice, right? Diversify, right?
Yes. Yeah, and that's a tenet that we live by, certainly when we're creating and constructing portfolios. No matter how good something looks, whether it's a company, an industry, a geography, or any sector, you don't want to have too much exposure to it, partially because you could be wrong, and it might not be quite as rosy, but also because there's opportunities in other sectors that just because you don't know about them, just because you don't understand them, doesn't mean that they're not superior to what you might be looking at that you're more comfortable with.
Sure, sure. Now, one of the other aspects of the aftermarket obviously relies on the continued production of vehicles, of new vehicles. They may not come into the traditional aftermarket for a few years once they're off the original equipment service segment. But there's a lot of change going on there now too, with EVs and but the internal combustion engine technology is still with us. There's hybrids, plugins, a lot of real push. I mean, I think that most of the advertising I see from the automakers these days is for certainly the kind of corporate brand image is all about EVs. But there's still a pretty small portion of the overall sales mix. What do you see that maybe catches your eye about that evolution?
Well, the biggest thing that catches my eye about that evolution is Tesla and the valuations that people are willing to pay for it, based partially, but not wholly, on their dominance in that space or their current dominance. It's a fascinating study overall in terms of what people are willing to pay for future earnings. And really, that's all investing in stocks or equities is buying a share of future cash flows. So there's the short-term game about whether a price is going to go up because there's going to be more buyers than sellers, but ultimately success in the equity markets is going to be determined by the cash flow that any investment creates. So Tesla is the absolute poster child for a fantastic and fascinating story, and also something of a perplexing situation from an investment perspective, simply because how much people are willing to pay for that future earnings set. But I mean, the whole internal combustion to electric vehicle transition is fascinating and is going to make the space very robust in many ways, I think, for the next number of years. Our sense is that it's probably not going to contribute to a significant increase in the number of vehicles sold overall. So it'll likely create a replacement from internal combustion engines to electric vehicles. Is it going to move production in the US or consumption in the US from 17 million units a year to 20 million units a year? Probably not. At some point, it probably brings forward some of the consumption for 2022, 2023, 2024 to now, if people find that there's something that they really want to move to sooner rather than later. Other side of the coin is we could imagine it putting off future purchases because of the excitement over what the options will look like 2 or 3 years from now versus what they look like now. So there's two sides to that coin, obviously. But it absolutely adds to the interest in the space. It absolutely adds to the potential vitality of the space. It creates a bit of a challenge, and it's one of the reasons that at Cidel we're not invested in the auto sector at this point, because that shift also implies some uncertainty. It creates a lack of visibility, in terms of how future earnings are going to play out, in terms of what margin compression may look like. Obviously, any of the traditional automakers have to put out huge amounts of money, and there's a big capital spend that's involved with shifting to electric vehicle production. So that represents a source of uncertainty. From a standpoint of how Cidel looks at companies and values companies, we don't like uncertainty. We like being able to model what future cash flows are going to look like, being able to discount that back to a current day price, and saying, all right, well, that cash flow that we can reasonably expect to be there under any circumstance is worth this today. The stock price is less than that, so we're interested in that situation. When you have uncertainty around either margins or capital spend, or what revenues are going to look like, it makes that process a lot more difficult. So that transition is super exciting in terms of how robust the space is likely to be. It's also a source of uncertainty for us in terms of what that modeling looks like, and just makes investing in the space a little bit more tricky.
Sure, sure. You mentioned that you don't see the transition from ICE powertrains to EVs as necessarily creating any uh, big bump in demand for vehicles. So the vehicle population will, kind of by extension, continue to grow as it would regardless, which is relatively good news for the automotive aftermarket, as those vehicles do get some miles on them and end up in service bays. But what I mean, that's sort of good news, I guess. Are there any headwinds that kind of looking kind of down the road? I know that that we've talked fairly positive terms about how the economy is opening up. Um, I guess asking for crystal ball predictions is really unfair, but are there things that do you are keeping an eye on, or that you and your colleagues are keeping an eye on, that if they were to spring up might create some uh, worrisome dynamics in the market? I mean, as you said, we've got all this stimulus in right now. We've got a lot of things going on. There's a lot of inputs in the economy. We also have a lot of folks in opposition to these packages, these measures.
Yep.
And I guess I am asking you for a crystal ball, but
Well, feel free to ask, but take the answer with a grain of salt, because my crystal ball isn't much better than anybody else's. I think there's two main things that we'd be worried about in the context of what you just said, Andrew. Um, the first is that the idea of stimulus and easy monetary conditions, and what I talked about off the bat in terms of the shift in thinking, is all it's all a big experiment. Like like there are some ways that it could go way off the rails, and I don't think anybody can say with certainty what that's going to look like. We've got massive inflation in some sectors right now, um, because of shortages in supply. If you cannot address those shortages in supply over an appropriate period of time through increased capacity, there's going to be far more inflation, because that's just how it works. More demand, less supply, higher prices. That could be very, very unsettling, and it could create all sorts of different knock-on effects through different parts of the economy. So the whole thing is a bit of an experiment from that standpoint, and that's a potential headwind for sure. Um, the other challenge is going to be, as economies reopen, like, our sense is that there's actually been a fair bit of capital spending on capital goods, whether it's cars or boats or granite countertops or bathroom renovations. There's been a lot of that over the course of the last year. What there hasn't been a whole lot of is spending on services. So restaurant visits have been curtailed, haircuts have been curtailed, nail trips to nail salons, travel, hotel trips, all that sort of thing. There's a limit, we think, to how much of that comes back once things are reopened. Like, you're not going to go for more than one haircut a month, no matter how much you may have missed over the last year. You're not going to go out to dinner 7 nights a week, or maybe if you do, it'll only be for a couple of weeks, and then you'll fall back into your normal patterns. So it'll be interesting to see, as we shift back to a more normal economy, what that transition looks like. And it's quite possible that current equity markets and current valuations are building in a little bit more enthusiasm than will actually be seen, because people maybe aren't going to get more than 3 or 4 weeks of holidays going forward, the same as they had going past, which doesn't mean that they can take 6 trips in 2022. They can still only take their one or two. So we get back to normal spending in those environments, but maybe that isn't enough to sort of carry the economy through on the growth trajectory that markets are currently pricing in. And that could apply to the automotive sector. It could apply to almost any sector that we're seeing. The other way that we put it, from a standpoint of risk to the financial markets, is at some point we're going to be more open in terms of the economy than we are right now. Until then, companies, and this would apply in the aftermarket parts section, it would apply to the automotive sector, would apply to a bunch of sectors. Until then, everybody has a bit of a free pass. We know that economic activity is constrained by the realities of the lockdown. Um, if anybody told you that Carnival Cruise Lines was currently booked at 15%, you probably wouldn't worry very much about it. But if we're sitting here in May of 2022 and they're still sitting at 15%, then you're probably not very happy at all as an investor, and very, very worried about the health of the company. So there's a degree of optimism built into the current markets. And I'm not saying for a second that it won't be justified and it won't play out, but you have to be aware of the possibility that things might not go according to plan. And if they don't, then what happens from a either central bank or government perspective? Do you think the U.S. administration will be willing to put a $2 trillion stimulus package in place and then do another $2 trillion in October or November if the economy isn't where it's at? There may be a finite limit. There is absolutely a finite limit to what people will be willing to do in that regard. So a change in that approach would be the other thing that nobody can model at this point. And there's certainly been no indication or inclination of governments anywhere to slow down on the stimulus. at some point they will.
Right. Yeah. And then, it feels a little bit like then letting it kind of stand on its own accord with the normal kind of economic demand and supply factors taking over instead of this sort of external, injection. And how that plays out. I know in the automotive aftermarket, because as in the US and in Canada and in many places, it was deemed as an essential business. So, it has been to a large degree, not completely allowed to continue to operate. There have been, depending on jurisdictions, there have been some restrictions and tamping down on it. So not everybody has seen kind of unabated demand and ability to service. But certainly compared to, the hospitality industry or travel and tourism, we've been very fortunate to be in that situation. So we're not likely, is kind of a question to see, like we're sort of already on the kind of the rebound and recovery mode, after seeing like a big dip early in the pandemic last year. A lot of organizations had some pretty good years financially last year.
Yep.
And I know that we talked about some specific companies just to give some trajectory to it. But as you had suggested earlier on, this was something that, if you had said to somebody at the end of March or maybe into April and May of last year that a whole basket of automotive aftermarket companies were going to be declaring best years ever from a financial standpoint at the end of their 2020 fiscals, after miles driven dropped sort of 40% or more in April and May, they would have said, you're crazy, yet here we are with continued growth and continued strong results, which, obviously if we want to make, a good case to the consumer and be there to provide the services, we have to have healthy companies, right?
Well, for sure. And that's, I mean, one reason for optimism at this point. I mean, you'd have to expect that the 2021 summer driving season is going to be a whole heck of a lot more robust than the summer of 2020, at the very least in the States, if not in Canada. So there are definitely things to look at from a financial management or from a stock perspective. We've got to try to figure out whether those expectations, that cash flow that will generate for the sector, is already built into the stock price. It's very, very difficult to look at companies the way we normally would, and that would be to compare Q1 of 2021 to Q1 of 2020. And certainly Q2 of 2021 is going to look massively different than Q2 of 2020 did. So those year over year comparisons are no longer as valid as they would be in a more normal time. I mean, what analysts will be doing is looking back to 2018, 2019. When can we get back to the trajectory that we were on prior to the pandemic? And in some industries, it's going to be much, much sooner than others for obvious reasons. Typically in the ones that it's going to take longer to get back to, like travel and hotels and restaurants and things like that, hospitality, those stock prices are lower than they are in areas where it's not going to take quite as long to get back there. But in areas like automotive and the aftermarket sector, how much of the enthusiasm about what's to come is built into the current stock price? And that's where the notion of modeling cash flows, making assumptions over growth that you're going to see in the next 2 or 3 years. But it's not even the next 2 or 3 years. It's the next really 5 or 10 years, because equity markets are not just looking at what will happen in the next 6 to 12 to 18 months. And thank goodness they're not, because they did from sort of March 1st to March 23rd of 2020. They were really only looking at what was going on at that point. And then there was a big shift to looking down the road. I think the next 6 to 9 months is still very, very uncertain in terms of how fully the economy is going to reopen. I don't have much doubt that it's going to, as we get more fully vaccinated and as we move through this this sort of flux period where we're not open, but we sort of are. We're definitely not doing all of the things that we'll be doing in 6 or 12 months. But just because we actually get to the point where we're reopening, it doesn't mean that and nobody's going to ever wave the all clear flag and say economic growth from here to forever. That's just not going to happen.
Right, right. Yeah, I know that again, you brought up again the issue of the vaccinations and the impact that that's having on being able to comfortably open the economy. There's a lot of still anxiety about it, and it's definitely a major factor in people's personal activity, which in aggregate is what gives us the performance of the economy, right? And some are calling for saying, oh well, when we're all vaccinated and pick a month, July, August, September, and then we're good. Um, that's a bit optimistic, right?
Yeah, I think so. I mean, I'm not an epidemiologist, although I've had to answer an awful lot of questions over the last year as if I am, and as if we've got a view on that. Um, that's one of the fortunate things about the way we look at the markets is, again, I'm not overly concerned about how the next 3, 6, or 9 months plays out. I'm much more concerned about the cash flow that the companies we choose to own will generate over the course of the next 2, 3, 5, 7, 10 years. Um, but yeah, I mean, from a market perspective, I'm absolutely shocked that there hasn't been more volatility over the last 6 months. Like from the beginning of November, we've basically been on a fairly clear upward trajectory in most financial markets. And that is hard to believe when you think about the amount of uncertainty that's out there. Kind of speaks to how we're not looking at the real short term and how we're focusing more on the longer term. There's risks there for sure. But when you've got interest rates as low as they are, and it looks like they're going to stay low for a protracted period of time, there's far less of an alternative to investing in equities and different things. I mean, I think it's a fascinating time for a number of the companies that you'd probably be interested in, and that your audience would be interested in. From a standpoint of free cash flow generation. Most of them probably have far more cash on the balance sheet right now than they would have expected at this point last year, certainly, but maybe even at any point prior to that too. Um, look for companies that are raising their dividends. Look for companies that are buying back their shares, partially as a reflection of what management is thinking about their next, not 6 months or 9 months, but their next couple of years, because very few people want to be raising a dividend now that they're going to have to cut in a couple of years. You know, Typically financial markets like that projection. So from a standpoint of evaluating the companies in the space that you're interested in, look for what management is telling you about their feel for their prospects going forward. And if they're buying back stock, they obviously think that that's a better use of cash than expanding production or expanding their reach or doing more marketing for whatever reason. That's a great question to ask investor relations or the management of any of the companies in the space. If they're raising their dividend, are they doing it on what they believe is a one-time basis, or does the company have a history of raising dividends, and does it look likely that that'll continue? Um, how are they talking about not the next 6 months, but the next couple of years? I remember we used to own Uniselect for our clients back in the days, back in the 2008, 2009, 2010 period, I believe, although I can't really remember. Time is a little bit hard to tell, but we used to have them come through our offices in Toronto. And I remember specifically stories about our research folks sitting around the table with them. And we wouldn't ask them what their next quarter was going to do, or the next 2 quarters, or the next 3 quarters. We'd be talking to them about what their plans for the business were 2 or 3 or 5 years down the road. And I remember the reaction of management was I think they found it very refreshing that we weren't focusing on what that Q2 number was going to be in 3 months, that
Right.
we cared about what their prospects were, what they thought their business could evolve into, what are their challenges, what are their limitations. Um, you know, a more holistic view of the business as opposed to just what's your next quarter going to be like.
Right. Right, right. Yeah, I mean, the kind of financial news stream from an aftermarket standpoint has been filled with the kinds of things that you're talking about now. Share buybacks, approvals. I think Advance Auto Parts, like $1 billion was approved to buy shares. I think Genuine Parts is looking at declared some strong dividends. some other, I don't want to exclude other great organizations. Those are two that come to mind. So these are, organizations that are kind of hitting the marks from what you're talking about right now. I don't have obviously the mind to keep, to understand what the history and all those are, but these are certainly positive things, right? So, I guess it shows confidence in the business going forward, right?
Well, and sometimes you have to parse that because, I mean, obviously the automotive and the aftermarket sector is a fairly capital intensive business. So you have to be a little bit careful that returning cash to shareholders doesn't speak to a complete lack of opportunities to expand your business. Um, we often say in financial markets generally hate it when companies cut their dividends. There are times when a dividend cut is appropriate to ensure the long-term health of a company. You're going into March of 2020 and you don't know what your cash flows are going to look like in the latter part of the fiscal year. Cutting the dividend is never fun from an investor standpoint, but sometimes it can be the absolute best thing from a company standpoint. So I would never look at a buyback plan or an increased dividend and just say clearly, well, that must be fantastic. There's lots of free cash flow, but that's a clue to sort of drill down into it a little bit more. And if you find that there are robust opportunities to grow the business and the company is doing that out of generated cash or has access to debt on very good terms, that can be a great situation. You'd obviously want to avoid a company that was borrowing to pay a dividend, for example. That is a huge red flag, because if you're not generating enough cash to cover your current dividend, let alone grow it, and are having to borrow to fund a dividend, that would be a red flag, for example. So there's lots of things that go into that analysis. I would say humbly that successful investing is not about buying something that's going to go up, in the next 2 or 3 or 4 weeks or even months. It's about being able to understand where a company's financial robustness, if you will, comes from, how sustainable it is, and how good the management team is at growing that.
Right, right. Comes down to people, right?
In a lot of senses, it does. You'd never want to invest in a company that didn't have a very strong management team and that couldn't um, uh, let you know what their vision of the company was. That couldn't get that out there, didn't have it clear enough to themselves to be able to communicate it. That's management teams are a huge part of what we look for in terms of companies that we want to own for a very long time.
Good stuff. I'm just going to mention a little bit of a kind of housekeeping, how this works. If anybody has a question, you can either put it in through the Q&A, you can enter it in the chat, or you can raise your hand. If you see along the bottom of your screens, the raise your hand, for me, it's a little yellow hand. If anybody has a question, raising your hand allows you to ask the question with your own voice. We can open that up for you. I'm not sure how much more we can cover on this. We've got so much, we've covered a lot of ground here, from personal portfolio management to be diversified, looking for robust companies, strong management teams. So we talked a lot about the automotive space, both now and in the future, and some of the uncertainty about the transition to, electric powertrains and what that might bring. From obviously massive investments for the automakers to make that transition too. So before we go, and while we wait, if there are going to be any questions, from an overall standpoint, as I'm just going to step out of the being an aftermarket guy here, but as somebody who's maybe has some money, and a lot of us in this industry have been, we've got a lot more gray hair than we'd like to admit, and so we're looking at making good sound investments with our portfolios and whatnot. What should we be focusing on, and what maybe should we be ignoring, just as individual professionals with kind of an investment portfolio?
Well, so I'd go back to the notion of not concentrating your investment exposure in the same areas where you're generating your employment income or your business income. I often talk, I've got a lot of clients that are in the banking sector. I would tend not to own any of the Canadian financial stocks for those clients, because their compensation is going to be tied to the banking industry and to the health and vitality of earnings on a year-to-year basis. You don't want your stock portfolio and your returns there tied to the same source necessarily. So back to that diversification notion that we talked about before. I mean, it's a fantastic or fascinating time from an investment perspective because interest rates are incredibly cheap. You know, you can borrow money at a fairly cheap cost and cover that borrowing with a dividend stream, for example. I don't recommend that most people or most of my clients leverage themselves to invest, but you know, for some people, this is the time to look at that sort of thing. Looking at the overall health of the company and what the downsides are to anything that you invest in. What's the case? What's the negative case? What's going to really hurt that individual company? And you know, is it a clear and present danger, if you will? That's the way that I try to think about things when we're in as ebullient a market as we're in right now. And I don't think there's any way to characterize it other than being fairly ebullient. I mean, if anybody had told you that markets would be 15 or 20% higher than the pre-pandemic levels a year after the start of the pandemic, it would have been a bit of a stretch. So yeah, nothing's cheap in terms of financial markets right now, but there are some very interesting themes when you compare how much you can earn from a dividend flow, for example, to how much it costs or what your other alternatives are for money. And I would say, as always, just make sure that nobody concentrates too much in one theme. It certainly isn't the time in the market to be taking on risk that you might be uncomfortable with if things take a turn for the worse, and sooner or later they will. You know, our biggest discussions with clients aren't whether there'll be a correction at some point or aren't whether markets will, you know, get soft again at some point. It's you know, is it likely to be 5 or 10% correction, which is kind of a garden variety thing that happens every so often and really doesn't mean a thing in the overall scheme of things? Or do the conditions exist to have what happened back in March of 2020 happen again? And we don't think that they do. But you know, you can't say that nothing would do that. I mean, the variants are an issue at this point. The vaccines are an issue if the rollout doesn't go as planned, or if, God forbid, there's some kind of setback and you know they don't do what they're supposed to. There's lots of things that could happen from an outlier perspective, but there's nothing that we can see at this stage that creates a calamity in the financial markets, at least based on the trajectory that we're on now.
Stuff. That's excellent. It's fascinating. You know, for somebody who's, you know, spends most of his time just thinking so specifically about the minutia of the automotive aftermarket. It's great to have somebody like you, Karl, to kind of take the broader view and get into literally the dollars and cents of it, right? So that's great. I don't have any questions up. So I think we're going to call it a day. Thank you, everybody who was able to attend today. If you're listening to this recorded version, thank you for listening. This is the opening session for the Great Canadian Aftermarket Trade Show. And we're glad you could join us. Thank you very much, Karl.
You're welcome. Thanks for having me.